oil prices plunging to start the quarter. Crude down more than 4%, as you see right there, hitting its lowest level in nearly 2 weeks. A few factors at play today. Demand concerns as coronavirus cases continue to rise worldwide. Will the economy slow as a result? And OPEC upping its output last month. The S&P Energy ETF, the XLE, falling 3% today, and that is after shedding a fifth of its value in the third quarter. Karen, what do you think of crude's collapse, and is this a time to hold your breath and get in, or just sort of watch it?
Well, there's something about the car wreck aspect of it that makes it sort of interesting to me. I mean, earlier in the year, crude was well lower than here, and I think Tim at that time was the only one who would have stepped in, and it popped a lot from then, and has retraced somewhat. I feel like we're in a secular decline over time, but I could see, if the economy reopens, that demand will come back. But I'm not going to be quick enough to trade around that. So I really am not that. I don't have very much energy exposure at all.
Tim?
Think about March 6th. This was a Sunday, I believe, but certainly when OPEC, really Saudi and Russia decided to play a game of chicken. And that was, in terms of the overall markets and risk, that was the first linchpin that sent the markets down. And it was just one ingredient. And think of where we've come since that time. I actually believe that WTI, I follow Brent somewhere around $40. I actually think the price action hasn't been that awful. It's been volatile, but holding this level is very important. I think more importantly, a lot of the equities are going through a painful either restructuring process, and I think there are some good things that happened this week. Whether you look at the restructuring across the board, the Devon WPX deal, Oxy selling off assets, there's consolidation that's not bad for the sector. I think it's ultimately good.
All right, let's talk a little bit more about that with our next guest, who says there is big opportunity in the beaten down oil sector. Let's bring in longtime oil analyst Paul Sankey of Sankey Research. Paul joins us on the phone. We're delighted, as always, to have you with us. Why don't we start where Tim left off, making the case that for some of the companies that are in this business, they are being forced or have chosen to make some important moves that could position them for greater profitability and greater health in the future. Do you see that taking place, and if so, where?
Well, exactly as Tim said. By the way, hi and thanks. Exactly as Tim said, we're seeing consolidation. We also had a couple of extra bankruptcies, unfortunately, this week. So essentially, the sector is restructuring. But the big problem here is just the demand side is not there, and you're still really disastrous demand environment. Additionally, seasonally, the oil price almost always falls after Labor Day because the refiners actually begin to go into turnaround. And of course, you have the end of summer driving. So it's not unusual for oil prices to be falling from their summer highs. It's just extremely unfortunate that the summer highs this year were only $40 a barrel. But yeah, there is definitely consolidation, and we are definitely taking out the weakest, unfortunately.
So as far as the price goes, you point out that we've left the summer driving season, number one. People are staying home more and maybe not commuting or taking long road trips as much, because if in this country you go across state borders, nominally you're supposed to quarantine in many cases. So where does, both for seasonal reasons and habits changing reasons, where does the price of oil settle in, say, December, January, March?
Well, I'll answer that immediately, that we think the low will be February, actually, of next year, which is the typical seasonal patterns. And we've said that all through summer. But I think it's important to highlight a couple of things. First, we talked about the whale, buying upside options in tech stocks, the SoftBank whale. My example was that we had the China whale. China was buying a lot of oil at the lows. And the concern today has been that China is weakening and has a lot of oil stored actually in floating storage offshore. So there's a problem that our whale has been beached, if you want. Secondly, airlines, it's not so much people driving. That's actually bullish. It's that no one's flying. And the IATA did a survey which found that 50% of people surveyed said they had no plans to travel by air in 2020. So there's a long way still to go. And that's really the problem in the sector, is that without air travel, you obviously lose jet fuel demand, which is going to stay oil-oriented for the next 20 years. And without that jet travel, we're just in a very tough cyclical downturn.
That's a very interesting point.
Hey, Paul,
I think.
great having you.
Go ahead, Guy, jump on in.
I'm sorry, Tyler.
No, please.
Paul, it's great having you on. Last time you were with us, I think Exxon Mobile, we were talking about the stock. You said there's going to be an opportunity to buy this at some point. It wasn't that day. I think Exxon closed around 33 today. I think the March low was 30. Is this it? Are we getting close in the big cap integrated? I'm not actually play stock market, but these names have been awful now for the last few months.
Oh, wait a second. I thought we were playing stock market. No, as I said, there's two problems with Exxon. Firstly, as I mentioned to you, the February 21 is when I think the low will be. If you remember last time I said buy Exxon, sell Apple. I actually haven't been run over in that trade. Apple's down about 8%, Exxon's down about 15%. And I said it was a 5-year trade, which is a bit of a cheat, obviously. But the oil price is a problem. And as you know, Exxon is enormously exposed to global refining. And that's also just a disaster until people start flying by plane. So it's too early. You have to wait until we get through this COVID. We've got to get people back in the air, and then refining will recover. Summer 21 could be a great year for refining because everybody's driving, nobody's taking mass transit, and if people start getting back in the air, we could have too much crude with strong oil demand. So Exxon could be back strong next summer, but this is going to be a very tough winter, and they had a profit warning this morning just for Q3.
Paul, thank you very much. Always great to see you, Paul Sankey.
It's always a pleasure.
It's great to have you with us. Tim, I'm going to give you the final word, but I kind of want to echo something that Paul said there, and it's kind of skipped my mind, and that is the importance of air travel in all of this. The last time I was on a plane was late February. I have no plans to get on one between now and the end of the year, and I don't know when the next time I will get on a plane is. I don't know about you all, but that level of demand has just been taken out of the market. Last thought goes to you.
Yeah, or sitting in rush hour traffic. I mean, there are a lot of places in the world where people were driving back and forth. They just are not in the short term. Follow the best balance sheet, folks. If you could find a company that's cash flow positive in this environment, has run their balance sheet, I do think that the WPX Devon deal, it's a merger of equals. I think it's an interesting deal to now look at that combined entity.
Shepard Smith here. Thanks for watching CNBC on YouTube.